You just have to keep swinging the bat, because there's no way to know when you put money in, you put 50 or 100K in at the seed stage, right? There's just no way to know which one of these things is going to be a $100 billion, outcome.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. We are back after a short break, and we've got a fantastic guest for today. We are joined by serial fintech entrepreneur. Do you like that, Mike? Serial entrepreneur?
Love it.
All right. Serial entrepreneur,
Works.
Mike Alfred. Mike started as a financial advisor, became the founder and CEO of Brightscope, the founder of Digital Asset Data, is a prolific investor in biotech, financial services, consumer companies. He serves on several boards. We're going to talk startups, investing, fintech. Of course, we're going to talk Bitcoin, and we're going to talk about the startup hub Exodus. Mike, thank you for coming on to the podcast.
Thanks, Phil. Thanks for reaching out to me on Twitter and making the connection.
All right. So let's start with your entrepreneurial journey. And in particular, I want to start with the point in time where you transitioned from being a financial advisor to founding Brightscope, if I have even that timeline correct. But, really, what made you decide to make that change? Why did you think you would pull it off? Was it harder or easier than you expected? What was that time period like?
Yeah, so great question. I, was a investor starting in about 1999, right? So when I was a freshman at Stanford, I had made a little bit of money selling Cutco knives. I don't know if you remember the knife salesman that comes to your house and cuts the penny with the scissors and all that. I actually made a lot of money doing that, and I put it all into an E-Trade account. And I ran up my account from 13,000 to over 50,000 in the first few months of my freshman year at Stanford. My roommate hated me because I was waking him up at 6 a.m, telling him about different stocks, how they were doing pre-market and whatnot. But it really whet my appetite for doing some more serious investing. Made and lost a lot of money before I even graduated from college, but gained a lot of experience. And so when I graduated, I wanted to do kind of retail financial advice. So I actually joined the AXA Advisors office in San Diego, and I went out and I cold called and I met people and I sold financial planning and insurance and investments, the classic traditional retail play. And in the process of doing that, I realized that there was a whole different model, right? There's this sort of captive insurance company, wealth advisor model, where you work at one of these big insurance companies or you work at Morgan Stanley or Merrill Lynch and you get paid commissions and you don't always sit on the same side of the table with the client. And I met a few RIAs and I said, wow, this model is so much better. You can invest on behalf of the client with discretion. You can get paid a fee. You can actually make real investing decisions. I met folks like Carolyn Taylor at Weatherly and Del Mar, who at the time had only like 100 or 200 million under management. I think she's over $1 billion now. Really nice ladies, took the time to sit down with me and really explain the RIA model. And so, a few years into that captive model, I said, you know what, I gotta open my own RIA. Funny enough, we just opened up. Fidelity was our custodian. We had like 10 million under management in 2007 when we recognized all of a sudden that we had a bunch of clients with 401k plans who didn't know how good they were, right? So if you went on Google in the year 2007 and you typed in, how good is my Amgen 401k or how good is my Pfizer 401k? There was literally zero information. You couldn't even get the list of funds held at other companies' 401k plans. You would only know the funds and fees and whatnot within your own plan. And even within your own plan, sometimes it was really hard to figure out, what the fees were, what the quality of the funds were. And so we realized there was this like huge opportunity to create something like what Morningstar did for the 401k market, right? And that's what pulled me into starting Brightscope. It wasn't that I sat down with a piece of paper and said, hey, I want to build software or I want to build a data business like Morningstar, Bloomberg. It was more that we had a specific problem that we were seeing with our own clients that we didn't see anybody else solving. And we thought, maybe we should try to solve this.
Over the life of Brightscope, what were some of the more memorable pivot points that you had? What were some of the forks in the road that really determined what the outcome was of the company?
Well, there was a bunch of them, right? I mean, starting from the very beginning, when you set up the company, and you've never done anything, you've never been a founder before, you don't even know how to allocate the shares, right? Do a Delaware C Corp or a California LLC, how do you figure out the vesting schedule? So there's all these sort of foundational components of startups that are really different, in my experience, from a lot of other careers. And so there were a lot of potential missteps that we got lucky in clearing up, right? Like, for example, on our first term sheet, first couple term sheets actually we got from investors, there were all kinds of gotchas around control, right? Where if we had signed those term sheets, even if we had been successful, we wouldn't have ended up owning very much, or we wouldn't have had any control over our own company. We managed to somehow sidestep those, even though we were pretty desperate to raise capital, right? So we raised that first $1 million in the summer of 2008. I didn't know anything about software. I didn't know where to get the data. And so we flew to Washington, D.C., and we walked into the Department of Labor, and we walked up to the guy in the EBSA reading room and said, hey, we need data on 401k plans in order to build our rating and help our customers understand, how good their plans were. And the guy just kind of looked at us. And so it's a long story, but we basically got the guy to give us access to his own company laptop, his own sort of government issued laptop, right? That had access to parts of the database that were not actually accessible. They were technically publicly available, but inaccessible using the old computer they had in that room. And we discovered these audited financial statements for all the largest 401k plans in the country, which served as the basis, like the data input for our initial ratings, which kind of launched the company. So I'd say that moment when we were in that Department of Labor government office, we could have turned around at the first sign that there was no data in there for us, but we kept hammering. We made friends with, his name was Devon Lowry, I still remember it, and we brought him donuts and coffee type of thing and made friends. And he wanted to help us, right? And most government employees don't. They don't care, right? As long as they get paid and they get their pension, they get to go home at night. And so that was a key pivot point. There was a key pivot point in like 2012 where we were selling a lot to advisors, and that business got up to about $1 million in ARR, serving financial advisors that were trying to target 401k plans. And then we had an advisor named Mike Falcon, who today is the CEO of Jackson National and was the CEO of JP Morgan's asset management business in Asia. But at the time, he was in between jobs. He was in between Merrill's wealth 401k business, and the JP Morgan 401k job. And so during that time, we made him an advisor, and he said, "Listen, guys, you have all this rich data, but the real customer here is these large asset managers and record keepers." And we didn't really know anything about that world. So he kind of helped my brother and I conceptualize of an enterprise version of the Brightscope platform, which ultimately is where 95% of the revenue came from, right? And in 2011, 2012, we were pretty blind to that market. So I think, obviously there's a lot of luck involved at these different pivot points along the way, but both in the initial raising of the capital, the discovery of the data, and then the conceptualization of the enterprise product, those were all kind of three key inflection points where if something had gone a little bit differently, maybe I never would have had the outcome that we had.
Yeah, and the ROI of those donuts and coffee for the guy at the DOL, I mean, you look back on that and that may have made, the $10 he spent may have made the whole company. And a lot of people that I talk to, founders, there's some sort of moment like that. There's some sort of like, well, they kind of had something they didn't. And then there was some gatekeeper or access point that they went through, usually, for the cost of a lunch or a nice conversation or the right intro. And it's amazing how much those can make or break a company.
That's true. And it's so parallel with the kind of wealth advisory model we came from, where you'd go to these meetings to see pitches on different products because they would bring you lunch, and it's amazing how much loyalty people have to you when you buy them food, which is why you should say no to a lot of lunches and dinners, right? Because unless you really, think the person has your best interest in mind, because you'll find you have more loyalty than you probably should.
Oh yeah. Yep. So when did the Brightscope exit close for you?
So we started looking, I started kind of having conversations loosely at the end of 2015, going into 2016. What happened is our growth rate throughout 2013 to kind of 2015 was in this kind of annualized 50% plus rate. And so we went from a couple million of revenue up to 10 really quickly. But then we started a plateau, right? And we were working really hard to try to expand the platform across from retirement into the retail and kind of RIA channels to help these large asset managers sell better in those channels. And when we did that, we started to run into these other companies like this firm Market Metrics based out of Boston that was 4 times bigger than us by revenue, but also had 15 million of EBITDA. And at the time, their platform hadn't really had a lot of work in recent years. They were surviving entirely on their relationships with customers, even though they'd done no real investment in the technology, going forward. And so it was this really interesting scenario where we were relatively smaller, but we actually thought we could buy this much bigger company. So we got this private equity firm based on the East Coast to back our bid, and we bid $175 million for this Market Metrics business. And we got outbid by another group called Strategic Insight that was backed by Genstar out of San Francisco. And once we realized we were getting outbid by them, I went directly to Genstar and Strategic Insight and said, "Listen, guys, here's everything we know about this transaction you're about to do that we don't think you know. And with that, I think the best way to solve a few of these things is to buy us too." And so what ended up happening is we went on the offensive to try to buy this larger business. And when we failed to do that, we ended up selling sort of through the back door. So by going on the offensive, we were able to get the company sold to Strategic Insight. And that transaction closed at the very end of October in 2016. It was a decent multiple. It was like 3 times, a little over 3 times revenue for a business that had essentially stopped growing, more than kind of mid-teens.
Yeah, that's an incredible story. And so that was 2016. When did you start Digital Assets Data?
So I took about 15 months and really helped on the integration. So keep in mind, Strategic Insight was already, a like $80 million, $70 million business that had both a software component and a media business. So they owned like CIO magazine, for example, right? And so they had a bunch of media properties. They were trying to integrate it with market metrics, but then they had also bought us. What ended up happening was this kind of $110, $115 million business was kind of hollowed out in the sense that most of these other units had a lot of revenue and a lot of EBITDA, but not a lot of great people, unfortunately, and not a lot of great new technology. And so my team effectively handled that entire integration over 12 to 15 months. Even today, my VP of engineering at the time is now basically helping to run technology across the broader firm. The firm's actually since been acquired. Strategic Insight was acquired by ISS, which then recently was basically majority acquired by Deutsche Börse, the German stock exchange. So, but still, 2 of my folks are still very senior within that whole organization because they did essentially the integration of SI. And then once SI got gobbled up by ISS, they stayed on and continued to grow it. And so after, spending the 15 months, I'll be honest with you, Phil, like there was a moment in there, you're getting paid a lot of money at the end and you're not doing as much as you used to when you were a CEO, and you start to wonder whether you've lost your mojo. And I was really worried about that. And so the moment something new kind of came up, which is thinking about building a crypto data business, I jumped on it. Part of it, frankly, was out of fear, right? Because I was afraid of becoming irrelevant. It seemed like an amazing opportunity, but I think if I had taken the time to think about it a little bit more deeply, I would have recognized that after 10 years of running 100 miles an hour, from basically 2005 through 2016, like it was time for me to take a little bit of a break and recharge and reset. But instead, I just jumped right into it, in January 2018.
There's something about the founder mindset. There's something about the entrepreneurial mindset where you can't do that. You just had this great exit. You could have just, said, hey, you're an investor, right? You could have just managed your money. You could have done investing for yourself, maybe for some other people, and really taken it easy. But it sounds like you really miss the action. You miss being in the game. And, I can certainly relate to that. I think there's a certain drive that a lot of founders have to really be in it, to constantly be in it. And it's not like, hey, I'm trying to reach a certain goal, a certain financial goal personally. It's that this is, like you said, your mojo. This is, this is you. This is how you're in your element, how you reach your flow. And, that doesn't end because, you have or have not had a certain financial exit.
That's exactly right. And it harkens me back to being a young financial advisor where I had a little bit of debt on a credit card, no real assets, struggling to generate consistent income. And I would have dreamed about having $3, $4, $5 million of liquidity. And I would have thought if I just had that, I would be happy and content. And the reality is I was more discontented with, a mid-single digit millions net worth than I was when I had nothing. And, Mike Bingle at Silver Lake, who I met with a few times during the sale process as we were just having informal conversations, told me, look, you're doing the right thing. Like all of us have to just get your grub stake, the first few million, the first 10 million or whatever, right? These guys who live in a different world, they talk like this. But it really rubbed off on me because my thinking was, look, this is just the beginning. I've completed inning 1. Now I got to figure out what the next few innings are going to be like. And, my very first call on this digital assets data deal, believe it or not, was with Alan Howard, the billionaire hedge fund global macro manager based in London. We talked for 8 minutes. He committed to take the entire first round of $1.5 million, and I ended up paring that back down so I could make room for folks like Mark Cassidy, the former CEO of LPL, who now runs Vestigo Ventures, and several others like that. And I wanted to have room for other folks, but part of me getting pulled into it was feeling, okay, I've got my grub stake. I need to figure out how to play at this next level. And I now have access to people like Alan Howard that as a young financial advisor, I couldn't even get, within 500 miles of. And so it's like, man, if you have this opportunity, how can you say no to it? And so I just dove right in.
And that's so important. It's so critical for a young entrepreneur who does not have access to, let's say, a permanent source of capital or does not have a track record that can attract those kinds of investors to get to the stage, to get to the point where you can, or, even if you have just one big name investor, that's enough credibility to bring others. You have a great lead. You have, somebody who believes in you. All of a sudden that opens doors that are otherwise closed to you. And having gone through the process now, once myself, one full cycle, I can tell you that until you get that first investor, it's extremely hard. Everyone talks about, there's so much capital out there, for startups. And it's true, but to get an allocation of that capital when you don't have a track record, when you don't have a permanent source of capital, when you don't have, friends and family able to do that entire seed round, it can be very, very challenging.
Yeah, and I would say, at Brightscope, it took 6 months to raise the first 900,000. And it was painful, right? My lead required like 8 or 10 meetings. Wonderful man. He's become a very close friend, but I had to meet with him 8 or 10 times, right, to get, a very small investment. He helped me raise the rest in that first round. Then when we started Digital Assets Data, it was like I had $1.5 million committed in 8 minutes and filled out the rest of the seed round, in very short order, and ultimately ended up raising around $10 million total for Digital Assets Data, right? And so that all happened in a very short period of time, and the caliber of investors was next level. We had 5 billionaires in the cap table this time versus 0, at Brightscope. And so I would say, actually, there's 1 at Brightscope, but it was at the very end. So I think that's exactly right. It's like you earn your stripes and you pay your dues, and everybody's at different levels along, the continuum here. And I think for me, the second one was easier to start, but it was much harder because psychologically I wasn't learning as much as I did the first time. Like, everything was fun when you'd never done it before. But once you already know what to do, for the most part, you really just want to see the business take off, and you really want the market to materialize. And that just really didn't happen the way we expected the second time. And so even though it was easier to raise money, it was a much harder experience overall.
I'm surprised to hear that. I'm surprised that you found it to be more difficult the second time around. I would have thought, well, you learned all the hard lessons on the first go around. You've been through all the pain, and now, it's smooth sailing. But obviously, best laid plans, right? So, tell me about that. I mean, what were the challenges that came up for Digital Asset Data that you had not anticipated, or that you thought you had already solved?
Yeah. So, I mean, I think at Brightscope we chose a smaller market that was much less competitive and was much more mature, right? So our customer base at Brightscope was BlackRock and Fidelity and Goldman and T. Rowe and Vanguard, Franklin. We had basically, if it's a top 100 asset manager that plays in the U.S. retirement market, they were a client by the time we sold the company, period, because we built a data consortium that was really powerful, and essentially you had to be in it in order to get the data back out, right? So it's pretty compelling. At Digital Assets Data, we were coming into a market that was much less mature, right? It was very, very early. The market is highly competitive. The narrative changes literally overnight. One day you talk to a client and they say they want X, and then 2 days later they want Y, right? Because something's moving in the market. The market moves so fast. But yet the actual market size for people who are willing to spend $50,000 or $100,000 on data is relatively small. So you had this weird combination of factors that made our specific business model challenging. Now, I think if you started exactly what we're starting today for the next 3 years, you'd probably do pretty well. But timing is a key component to success in startups, as is market size, right? And our market didn't develop the way we expected. I certainly made some mistakes on product clarity, on some hiring decisions, but those are things that are never fatal by themselves if the market cooperates. So some of it, I'd like to believe I have full control over my own destiny, and most successful founders do tend to demonstrate that they have a significant amount of control over their own lives. I think if you're really honest with yourself, you recognize that the range of outcomes is sometimes impacted by forces beyond your control. And so while I didn't make a lot of the same mistakes that I might have made the first time, a lot of the outcome had nothing to do with those decisions. They had more to do with the market evolving in a way that nobody expected. I mean, if you look at my cap table, there were like 30 investors in there. 15 or 20 of them are among the very best investors, on the planet, period. And they all believe, like we did, that, the crypto market was going to develop very rapidly. The problem is we started the company at the beginning of essentially like a year or two bear market, right? The price of Bitcoin was a headwind from January 2018 all the way through, March of this year, essentially, with some variation in between there. Only very recently did the price break out, which was shortly after we had already sold the company. So again, I'm not sure that I made any mistakes that are going to be that instructive for others. But what I would say at a high level is that just because you've done it once before doesn't mean that you could do it again and that there won't be things that go against you, right? Because of the forces of luck, because of the market differences, because you're going to have different people sometimes. And so it just played out the way it played out.
All right, let's talk about your investing approach. Traditional investing. We'll get to crypto later, but let's talk about just investing. What is your investment philosophy?
So, at a very high level, I would describe myself as a value-oriented investor that's not afraid of new things, right? So when you think about the classic Graham and Dodd value investor investing in cigar butts, low multiple type companies that you can extract a lot of cash from over time, or that typically, you're investing in because the expectations are very negative and you hope that the reality is a little better than negative, as opposed to a growth investor who's always looking at the future and always thinking things will be better than expected, right? And so I have kind of a barbell where on one end I have a whole bunch of value-oriented equities where I've gone very deep on those companies, and I tend to buy them when they get relatively cheap, and then I hold them for a decade or more. And then on the other hand, I have things like Bitcoin that I view as one of the most important ideas, of our lifetimes, that I use on the other side of the barbell because I think there's an exceptional return opportunity there. And so I think when you blend Bitcoin and biotech and early stage investing with traditional value investing, what you get collectively is a portfolio that exhibits a lot of really good traits that you won't see in either a growth investor's portfolio or a traditional value investor's portfolio.
It's very unusual to hear someone who is, in the startup world around VCs. I mean, I've joked on Twitter, there are no value investors in venture capital, right? You're trend spotting, you're looking for momentum, for companies that are building momentum. In the crypto world, I guess there's no reason why crypto would be mutually exclusive from value, but it feels like it is. Maybe I'm wrong, but you certainly proved that that's not always the case. But it seems like they're very different worlds. Somebody who's sitting there with Ben Graham style, value investing, trying to figure out what is the intrinsic value of a stock and where can you find a discounted company, versus people that are, in the crypto space. It just feels like a very different world. But I suppose there is, from a quantitative standpoint, certainly there is, some balance there, and there's a cyclicality and a low correlation between the two.
I think, venture is a different beast, especially early stage. Like, you don't want to be a traditional value investor in venture because of the power laws of return. You really need to find the highest growth, highest momentum, market share winners. And so trying to buy a company's equity at a discount, especially at an early stage, is usually a mistake. I think mature markets are just so different, where value investing does work over time, in part because you're actually finally extracting cash flow through dividends, through buybacks, et cetera, that you don't have at an early stage. And so you've got these like wide dispersions of returns at early stages that doesn't really allow for, like, you didn't try to save $10 million on your valuation in Uber at the seed stage, right? Or at the Series A, right? Because it makes no sense. You just need to be in Uber, right? You need to be in DoorDash. You need to be in Airbnb, et cetera, right? And so being value investor makes no sense. But with publicly traded companies, people who think that they're being VCs by buying Shopify or Zoom are absolutely insane. Snowflake at 100 plus times, sales. That is guaranteed to be a money loser if you buy and hold a basket of those types of equities at these prices. They're not bad companies. It's not that different than buying Microsoft in 2000. Like, it took a long time. I think it took till 2016 to actually make money. So I'm pretty confident you lose money over 10 years buying Shopify, Netflix, Zoom, et cetera, Snowflake, all these publicly traded companies. Whereas I think if you buy CVS, Bristol Myers Squibb, Albertsons, Kroger, a handful of companies like that, you're probably going to annualize at 10, 12, 15%, which is going to look really good, especially relative to a basket of tech stocks when you look back 5 or 7 or 9 years from now. Now, I'm not predicting a swing back from growth to value by any means. I can't time that. I just know over longer periods of time in these large publicly traded equities, the valuations tend to revert to the mean in ways that you just don't see in venture.
Yeah, no, I agree with that. And that brings us to Bitcoin, which, so, we have to kind of timestamp it. We're recording now January 3rd. Bitcoin is oscillating around between $32,000 to $34,000 per coin. It's doubled in about a month. I don't know. I mean, make your case.
So, I mean, you've been following me for a short period of time, but I think you've seen I've been really, really bullish. And if you were following me in March, I was all over telling people that was a time to buy, between 4 and 5 and 6K heavily. And even before that, right, previous cycle, I was getting my father-in-law into Bitcoin at between 1,500 and 2,500. And unfortunately, that first go around, that bubble cycle was just so frothy that I was calling people probably a little early, between 10, 12, and 15, and saying, hey, you should take some off here because this is clearly a bubble. And I think it's very reminiscent to the tech bubble, because I traded all the way through 99 to 2002, right, with my own money. So I'm very confident in the analogies between the two, because I've seen so many things that are almost exactly the same. And that is that, people were right about the effect the internet was going to have on the world, but they were wrong at the time about the basket of internet stocks that you should own, because most of those stocks in 99 that were going crazy weren't actually the important ones to own. Right. And so the same thing sort of happened here in 2016, 2017. You saw a bunch of money flow in because of the future of crypto and blockchain, which I believe is just as significant to society long term as the internet has been. But if you threw all your money into Bitcoin at 20,000 and a bunch of other shit coins, that some of which don't even exist anymore, then you had a good chance of losing money. I think right now today you're in this most extreme monetary backdrop that you've ever really seen in human history. I mean, the numbers aren't just big on an absolute basis; they're big on a relative basis. In terms of the trillions of dollars of stimulus and intervention that are happening. It's every government essentially around the world manipulating markets and manipulating currencies at the same time. And so, this idea that you can buy an asset that is hard capped in its supply. It's dictated by code. You can't manipulate it, right? You can't change the rules, mid-flight like you can with all these other assets, is very attractive. And I think people are going to dramatically underestimate the future return potential, because every single cycle for Bitcoin tends to run several standard deviations beyond what you would expect just using a standard stock to flow model. And so while, the most bullish people today are kind of calling for 2, 3, 400,000, it's possible that Bitcoin goes well beyond that within the end of this cycle, which I think will probably go until 2022, 2023. So, we're at 32,000 today. Obviously, we were just at 15,000 a couple months ago. We were at 5,000 in March. But nobody should be surprised, just based on the lack of supply and the fundamental demand under the surface from traditional allocators that are now coming into the space, if we see 400,000 Bitcoin within the next 24 months at the high end.
So I want to unpack one thing there, because when you talk about the hard cap supply, that's one half of it, and then you mentioned the fundamental demand. It seems to me that there, with something like Bitcoin that's not tethered to any intrinsic value, that what it is a bet on the supply demand, right? And the idea that demand is, I guess, my thoughts on Bitcoin personally are not really fully formed, and I'm not really that dug into either side of the debate, which is pretty unusual. I think these days, it's a fairly polarizing thing, and most people are pretty firmly in one camp or the other. But the thing that just sticks with me, the thing that I cannot get past, is the fact that what it is, in my mind, is a bet on the continued demand, the continued increase in the demand for Bitcoin. And it's been amazing to see that the hodlers, right, the people who own Bitcoin, have not capitulated through multiple bear markets and through some pretty intense and long bear markets. There has not been like a big dumping of their Bitcoins, and people have mostly held. But in order to continue the price to be pushed up, you need to have increasing demand. And I feel like that's why you see so many of these people, on Twitter trying to convince everyone, or getting really mad if somebody says something negative about Bitcoin. It seems like a lot of the game is just about creating that demand. Am I wrong in thinking that?
Oh, there's just so many things to unpack just with what you just said, right? That shows a lot of where you start your thinking about how to value Bitcoin, right? And so, for example, intrinsic value, would you agree that the US dollar has about the same level of intrinsic value as Bitcoin, or no?
I mean, the faith and credit of the US government is worth something.
Okay. Well, I would agree that it's worth something. I just think that value is actually decreasing pretty dramatically
Oh,
over
for
time. And
sure.
as specifically as it relates to the U.S. government and the U.S. dollar, the threat of inflation is real and certain, right? There's just no world in which if you put a $100 bill under your mattress and pull it out in 10 years, that $100 bill is going to buy you more goods and services, particularly when we've created 35% of the outstanding money supply that's ever been created in the last year. And so I think intrinsic value is this sort of moving target. All that said, there are some ways you can value the Bitcoin network that are not going to be intuitive if you're thinking about traditional, assets like equities or bonds. Like, for example, if you think of money as a transfer of energy, Bitcoin's one of the most efficient energy transfer devices in human history, right? Because you can transfer digitally, you can divide it any way you want. The cost of storage is much lower, right? The security of the network is another way. So as you have more miners and as you have more hash power on the network, you're actually securing this network. I tend to think of Bitcoin like the telephone, where if there's only 2 telephones in the world, the telephone doesn't have a lot of value. But if everybody has a telephone, the value is exponentially higher. Bitcoin is a monetary network with the same properties as the telephone. The difference is you can buy a stake in that utility directly versus the telephone. You could buy a telephone and use it as a consumer, but you could not buy a telephone token for 0.0001 cents in the year 1925 or whatever, right? And so there's the security of the network component, right? Then there's also a store of value replacement. And so when you think about things like gold, where, that has no real, it has some intrinsic value. Like you can put it on your teeth if you want, right? And it looks good on jewelry, but effectively it's not that efficient of a store of value. And as it rates on money on multiple different dimensions, the only dimension where it's really better than Bitcoin is the amount of time it's been around. And so if you just think of it as a store of value asset, Bitcoin is far superior, but yet trades at a small percentage. It's under 10% of the market cap of gold. Just a few months ago, it was like 3%. Right now, it's like 6 or 7 or 8%. It's growing really quickly. And so if you just market size this and you think, okay, gold's 9 trillion, fiat currencies are tens and tens of trillions or more in terms of demand, Bitcoin should capture some percentage of that demand over time. That's how you get to these seemingly astronomical price targets that to me seem almost inevitable at this point.
Yeah, no, that's a great analogy. I love that telephone analogy. That's definitely an interesting thought. What about the idea that there's going to be, Bitcoin 2.0? Maybe it's Ethereum, maybe it's something that hasn't even been developed yet. Maybe it's some coin that, nobody but the most diehard crypto investors know at this point. What if there's something that comes and displaces Bitcoin?
So I think the train's left the station on Bitcoin as a store of value, period. All these arguments about how quick the Bitcoin network is, right, in terms of processing transactions and all that, don't really matter because brand and network effect is everything. It's a winner-take-all store of value market. Nobody's buying ETH as a store of value, right? I think there's really only 2 investments that you have to make in the long run in crypto, and that's BTC and ETH. But the ETH investment is a totally different use case. It's a totally different thought process. ETH doesn't, in my mind, compete with Bitcoin as a store of value. And so what the world that I'm really looking for is this world post the transition of a US dollar or say Chinese yuan, denominated world into a world denominated by a store of value that's actually cleaner, simpler, less manipulated. And so I think that's coming. I think people will start thinking 2, 3, 4, 5 years out in terms of their assets denominated in Bitcoin. And I think when that, hyper Bitcoinization happens, I think we'll no longer be thinking that Bitcoin is increasing in value so quickly because we won't comparing it to a value of an asset that's decreasing really rapidly, which is the US dollar. It's just a different paradigm. And I get it. That sounds a little crazy today, but I think it's going to sound pretty normal in 5 years to talk about it that way.
Mike, I like to close with this question, which is tell me an obstacle that you've had either in your personal life or your career that you either found a way to work around or just persisted through.
So there's a couple, there's a couple things that have been challenging for me. One is that I'm a really good investor, but a really bad trader. And when I get frustrated, as I have been several times over the last couple decades of investing, I tend to try to position size up and take bigger swings right at the time I should be doing the opposite. And tends to happen like every 5 or 6 years. So I'm consistently working on creating the right guardrails to prevent that type of behavior. And then another thing that I've recognized in myself more recently is just this feeling that I haven't had the level of success that I should have had relative to my potential. This feeling that like, man, I haven't started a unicorn yet, right? And I haven't invested in one yet. And it's just this feeling of kind of inadequacy. And I had a good conversation with one of the most prominent VCs, early stage VCs in the country, who just had a major exit IPO in the last few weeks. And this was like one of his biggest hits ever. And I had a conversation with him and I was telling him about how I was feeling this. He said, look, man, like you just have to keep swinging the bat, because there's no way to know when you put money in, you put 50 or 100K in at the seed stage, right? There's just no way to know which one of these things is going to be a $100 billion, outcome. And it stuck with me. It reminded me that I got to keep fighting through this feeling that like I haven't quite achieved my potential and just keep going.
I love that. That's great. Mike, where can people learn more about what you're working on, and how can people follow you?
Just Twitter, Mike Alfred, and LinkedIn. Look me up that way. I don't have like a website or anything right now. And so my focus is on doing my best work there. And then at some point I'll be starting something new.
All right. Well, thank you for joining the show. That was really great. Thank you to our listeners for your time and attention, and we'll be back when we're back.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.